Are you looking to grow your career in finance or investment management? Introducing the new CFA Institute Associate Membership. Gain access to a global professional network, exclusive resources, and opportunities to learn and connect. Visit cfainstitute.org to get started.
Leading a financial service firm requires a distinct approach to strategy and leadership. That's why Harvard Business School Executive Education offers a 5-day in-person program focused on leading professional service firms. In this program, participants like you will explore topics such as corporate culture, retaining talent, and communicating a strategy and vision. By the end of the program, participants will gain frameworks to lead change while preserving client satisfaction. Explore the program at hbs.me/client. That's hbs.me/client. Welcome to Compound Insights, a podcast by CFA Society New York. I'm your host, Gary Farber. Today we're welcoming to the podcast Dr. Mark Malek. He is the Chief Investment Officer for Siebert Financial. Mark leads portfolio management for equity, fixed income, and ETF platforms. Mark, welcome to the podcast today.
Thank you for having me. It's great to be here.
Mark, given your tenure, you've obviously been through several investment market cycles. Are there any particular observation or rules of the road that have shaped your investment philosophy?
Absolutely. I mean, there've been some pretty interesting ones since I've gotten into this business. A lot of folks today are facing the current markets which are absolutely crazy and very interesting, and there's so many new twists and turns. But for those of us who have been doing this for a minute, we see a lot of similarities, right? So obviously, the biggest thing that you learn having lived through this before is to become, of course, less reactive and try to have much more of a holistic view. And to recognize, of course, that there are so many things that are influencing what the market's doing today. Take a broader view. A lot of people focus on a specific, a myopic view of where they may sit in the market, not realize that, maybe fixed income has an impact on this, maybe Forex might have an impact on this, or, maybe something going on at a foreign central bank, right? So, we had Bank of Japan just raise interest rates last night while everyone was sleeping. And many people might just completely ignore that on a day like today when we have so many more shiny headlines that we might want to focus on. The Fed, SpaceX, of course, you can't miss that one. But maybe there's some implications that the Bank of Japan just raised to 1%. It's the highest it's been in probably 3 decades. Maybe there's an impact there. So I guess the big takeaway is that if you've been doing this long enough, you recognize that there are so many more data points that you might be missing that you really need to step back and make sure that you're factoring all that stuff into your decision process.
And specific as we meet today, as you reference, a very dynamic investment environment, geopolitical tensions, very large, seem like they may have toned down a little bit in the past couple of days. How do you approach the market when that's the type of backdrop, and how do you incorporate that into your investment mosaic?
Yeah, that's a really really tough one to learn how to do it properly, because we have had so much of this. Geopolitics. There are two. I would put it in two different categories, right? You have the geopolitics themselves, which are obviously very tangible and very real and have real quantitative implications. But then there's also the headlines, which kind of really, unfortunately, obscure in a lot of cases the reality. So, starting with the headlines, I mean, we see a market today that's very much trading the headlines, and we've seen that obviously been very much the case for the last 2 years or so. Maybe the last, let's call it 18 months, that the headlines have a very large impact on the market. Of course, the first thing to do is make sure that you're not just trading a headline, which was based on a tweet. We have to make sure that we immediately qualify anything that we see coming across the tape as being something real. And that in and of itself, Gary, has been a big challenge, as you probably know, lately. So, finding, the source of the headline, and then if that source does have an impact, in a lot of cases, what we do here is we try not to trade the headlines. We make sure that we wait for the results, something that we can quantify. We don't like to make trades or changes in our portfolios, based on, on headlines, on tweets. Obviously some of those can come to fruition, and some of those might portend those ultimate things. But at the end of the day, we have to make sure that everything is quantifiable and that we run all of that stuff to ground. And so for us, once we get through that layer of, okay, we know it's true. It's really, the macro backdrop again is, even though this globalization trend that we spent most of our professional careers focusing on, there are forces that are trying to dismantle that, those global connections. But whether that ultimately happens or not, recognizing that again, that all of these things are attached, and then taking a very broad view, quantifying, qualifying, and then we make decisions based on that. And again, a lot of these still come back, Gary, to some of the real basics of economics, things that we have been practicing for our entire careers, even though they seem more complicated and complex, and at some level they are, mainly because of the messaging. But at the end of the day, when you see interest rates rising, there are implications. When you see consumer prices rising, there are implications. When we see stocks trading in front of their headlights, that are not necessarily tied to fundamentals, there are certain things that we have to do to qualify that stuff. And maybe that's another question. Maybe that's a different question, but that also is obviously a very prevalent theme right now in the current narrative.
And we're also near the close of the second quarter here. How do you think about corporate earnings, given what's gone on in the macro lately?
Yeah. So, well, we had a fabulous Q1. And, I think across the board, we saw numbers beating certainly our expectations. And we're not alone, right? So, the analysts on the street, would like to see what all of them are thinking as well. And so, I think all of us were pretty happy with what we saw in Q1. I think there were a couple of maybe sort of hidden issues out there that we're watching very closely. But we recognize that this type of growth that we're seeing in earnings can't exist forever, and we will at some point see a slowdown in growth across the board. Even if you just do the basic math, right? The base effect, right? So at some point, that year-over-year growth figure is going to at some point lose a little bit of momentum. Question is where does it happen first? And so, we go into this next earnings season with high hopes. Hope is not a strategy, but we are expecting to see continued good numbers. But we're really going to be watching very carefully the forward guidance. We feel like there are definitely there are going to be some definitely issues that will possibly arise from the Iran war. I don't think we've seen inflation move through the broader economy just yet. Related to that, the supply shock related to, let's say, energy, right? Of course, we've seen consumer prices rise because gas prices are going up. But we haven't quite seen what the fallout might be as those costs, you go through the rest of the the complex where prices of goods, inputs are going up. So we haven't quite seen that just yet, and we're going to be looking for that type of stuff. Will that start showing up now? And more importantly, again, when is that demand destruction going to start? Right? We know prices are high. We all experience it, no matter where you fit in the economy. The question is when is it going to start affecting that consumption? When is it going to start affecting the actual revenues, right? Not necessarily the incomes, the net, the contributions, et cetera. But when is it going to start to impact revenues? And we know it's going to happen. The question is when, Gary, right? So, this is where we're going to be watching with, two magnifying glasses. And Q2, running into Q3, we're lagging obviously one quarter we're going to start. We're definitely on watch right now for next quarter. Although we are expecting a pretty good quarter where we
And
sit
Mark,
today.
you just referenced inflation. Let's dig into the macro a little bit more. We have a new Fed chairman. What do you think that means for interest rates and markets?
Yeah, that's a tough one, right? If you just do everything in a if we assess the situation in a vacuum without Kevin Warsh as the new chairman, we see a Fed that continues to be hamstrung. We clearly have headline inflation. We clearly have inflation injected in the system, right? Just by looking at the recent PPI reading that we had. So we expect that inflation will eventually show up on the consumer prices. Fed, this is not being at all ignored by the Fed. We are seeing, interestingly, when we looked at the last CPI number, interestingly, we saw the core number tick up a little bit, right? Which is interesting, which can maybe hint that this inflation is moving beyond just fuel, right? So let's say housing numbers, which were a problem before, and services inflation. That was a big part of sticky inflation. That was coming down really, really, really slowly before the Iran war. That ticked up a little bit in the last CPI reading. Fed is seeing this. The Fed has clearly signaled a penchant to move away from its dovish regime. So, without Kevin Warsh, we would expect the Fed to possibly remove their bias toward easing. On that alone. Now, there's a separate question, which is what's causing that big spike in inflation that the Fed is so worried about, which we think is a supply shock inflation, which unfortunately the Fed can't fix with interest rates. And so that is where I think that's one problem they have, and this is not escaping those folks that are smarter than we are, and they're seeing numbers, so they know that they can't fix inflation by raising interest rates. But they have to stay credible, which means they have to stay vigilant, which means they have to say that they're going to be tough on inflation. What they say and what they do, two different things. Kevin Warsh comes in. He's an interesting guy because, he has very much telegraphed for the last several years what his stance is. He may have softened that up a little bit for the Senate to get the job. But the question is what does he do, right? Does he come in? Is he going to be the hawk that we think that he is? But even if he doesn't come in strong and say, hey, let's push for higher interest rates, a lot of the changes that he's proposing to the Fed, the more of the structural type changes, right? A move away from QE, releasing the balance sheet a little more quickly, because he's been a very big opponent of that, right? Which is one of the reasons he cited for leaving the Fed in the post-financial crisis era. If he comes in and starts pushing on that, that's tightening, right? That is tightening. Another factor is that we're watching is that he is very much an opponent of forward guidance. And the market, all of us have become quite addicted to that forward guidance, the dot plot, all that kind of stuff, whether it's real or not. The fact of the matter is the market prices itself based on that forward guidance. Bond markets certainly price themselves based on that, at least as a starting base level. And there's a speculation that he might remove that pretty quickly, like take away the dot plot. This is one of the SEP meetings, right? So we're going to get the projections this meeting. Warsh could really make it that much more challenging. If they remove the dot plot, if they remove forward guidance, you could see bond yields, pricing in a little bit more risk. And of course, once interest rates go up, that puts pressure on stocks, certainly these days. And so you could see a lot of very interesting stuff. I mean, I haven't even brought up the second part of the dual mandate, which is the employment situation, the labor market, which on the surface also looks very healthy. and the Fed is calling it healthy. And so the fact that they're not concerned about the labor market, which I have a lot of concerns about, and the fact that they are very concerned about inflation just indicates to me that, wow, this is going to be a rough year. Market has priced for it. Absolutely. Futures, if you look at Fed funds futures, they're somewhat, at least they're somewhat aligned with where we think the Fed is going to be, where historically, as you recall, the last couple of years, we've seen a divergence, right? So the market sort of was hoping for something more dovish than the Fed was willing to go for. So right now, I think things are pretty aligned. I think if things go the way they are in a vacuum, you could definitely see a tightening bias by the end of the year. I wouldn't be surprised to see a rate hike by the end of the year. Certainly, if the situation in Hormuz does not end quickly as of Friday, although I don't think it will, because even if it ends Friday, the inflation is still out there. You're talking about late in the year before some of these supply challenges ease up, even in the best case scenario.
And is this 2% inflation target, is that still the right anchor, or should we have a more flexible regime when we approach that?
Yeah, that's interesting. I think having a target is not a bad thing, because even if you're in a boat in rough waters, you have to find a waypoint to focus on. Now, whether 2% is the right number quantitatively or not, I've read a lot of research on this newer world that we live in, specific with AI spending and specific with productivity. Um, Whether that 2% number, I was never a big proponent of the actual 2% number, right? So, Gary, if we look back at history of CPI, the long run, the mean of that number is higher, somewhere near to 3%, right? And so we survived all these years with 3% inflation. But we're in a different environment now. I think the challenge is not really the number so much. I think there needs to be a new way to think of things, and I'm eager to see how the new Fed deals with it, because I think what's affecting Americans right now is less about inflation and the 2% rate, right? Remember, it's a rate. It's just where prices were a year ago versus where they are last month. And so that rate of change is important. Like, we don't want to see it growing fast, but the reality is the rate of change of prices is less important than the actual prices of things right now. And I think that's what has gotten lost in this recent spate of inflation that we had post-COVID. I think the base level of everything is just already so high that I think that is what is really affecting consumption, not necessarily how fast it's growing. Of course, it's important. But whether that 2% number is real or not, I'm eager to see. I know that Warsh will come with his own calculus. I've read a bunch of stuff on that. It'll be eager to see what happens. I don't think they should get rid of it. I don't say they should do a wholesale change and say, no, 3.4% is acceptable. It's really, at the end of the day, how the Fed acts, right? That really is the most important. And remember, that 2% number and where we were is a big part of that signaling. So we have an idea what the Fed might do. So, we're going to have this conversation again, I'm sure, after we start hearing from the man himself.
And what about global interest rates? What are the trends there? I know you've published some research on Japan and have a thesis there. How should we think about that, and what does that mean for the markets?
Yeah, unique, very unique situation. Thanks for bringing it up. I mean, we saw Bank of Japan last night. We saw the EU last week raise rates and signal that they have intentions of raising further. And so, you're seeing now the U.S. Federal Reserve used to be really the ones calling the shots with interest rates, right? So the U.S. Federal Reserve would move, then we would see others move and follow to maintain, flows of funds, to maintain currency stability, and so on and so forth. Because when these banks change rates and they don't move together, you see flows of funds getting all messed up. It is so rare to see other countries move before the U.S. But you saw it twice in a row with two of our largest currency trading partners, right, in the EU and Japan. And you saw them move first, and you saw them raise rates. Now, these are not ordinary times. Japan has a lot of inflationary pressure right now, and they have to act for themselves. And a lot of what you've seen in Japan's recent inflation has been sparked by, of course, energy, that supply shock inflation that we talked about. And in Japan, it's very much a problem, right? Because they actually have a literal supply problem. They get a lot of their energy product from through that Strait of Hormuz, where in the U.S. we don't have a legitimate supply problem; it's just a pricing problem. Similarly with Europe, the EU. So you're seeing central banks operate on their own in their own interest. Um, can some of it be politically driven, right? Because we live in a very divisive political environment with trade right now. The answer is possibly a little bit, but I think a lot of countries now are trying to protect their own house. So you will see these companies raise rates, but I will tell you that that puts pressure. So the EU raising rates and the Bank of Japan raising rates unilaterally is certainly something that they're talking about today in their Fed meeting, guaranteed, because that's a pressure on them now to follow suit. Otherwise, there's a disequilibrium. Now, whether they choose to accept it or not, that's up to the smart people in the Eccles building. But I would say that is definitely something in their calculus right now. And it's a different regime than we've seen in the past.
And Mark, shifting into investment themes, are there particular ones that you find compelling right now, or even for the longer term?
Yeah, well, I'm going to say the most boring thing in the world to you right now. You know, there is still a lot of growth out there in terms of on the equity side, regardless of interest rates, regardless of this tough inflationary environment, regardless of the geopolitical risk. And there are geopolitical risks that affect the technology sector, right? So you knew where I was going with that one, didn't you? Um, we still see a significant upside growth, very, very real growth built on some very real solid numbers going forward from here. So, we are definitely favoring sort of the growthier areas, the usual suspects in technology over there. We think that a lot of the other sectors have been riding higher, are a little bit costly, and don't nearly have the potential growth, don't have the fundamental support to support if the economy does crack a little bit, where the tech sector could weather the storm. It's not going to be a fun scenario, but if you had to put your money in one area, we feel like the growth there, will continue. Now, to be fair, that growth doesn't go on forever. If we talked about this last summer, I would tell you that, we had 24 months plus. Now I would tell you the runway is getting a little shorter, right? Because the numbers are getting so large. One has to start to factor in some form of decay at some point, right? You can't just continue to grow in a straight line. The math doesn't work for any of us who've been doing this long enough. You don't want to see we don't want to see a line going forever, and we don't want to see it tailing up forever. We know that there will be some eventually diminishing growth over there, and that time is not around the corner. It's beyond 12 months. But that period of 12 months to 18 months is I think it's a blind spot for all of us right now. We all suspect that that's the area where we're going to have to get smarter as we get closer. And I will also be very clear here that just because we love tech and we love all these things, I want to first say that not all tech is the same, right? A year ago, last summer, we could have invested in a tech theme and done well. We could invest in earlier, like 6 months ago, we could have invested in a semiconductor theme and done well. But we know that not all tech is the same. There are software companies, and they're clearly not all the same. And so we have to be smart because there are some troubles at the fringes, companies trying to take advantage of the AI to hide in the shadow of the AI umbrella that don't belong there. But I want to make it clear that we still are believe in diversification, right? So we are still investing across the board, right? So we're still investing in other sectors, and we're changing those based on where they go. But I would just say, in terms of our most constructive area tends to be more in growth. I think a lot of the more defensive sectors are getting a little pricey. That can't necessarily justify large conviction investments, but we're there. I mean, we like to say we'd always like to see some green on our screen. And so we are always very diversified across the board. We have plenty of financials, plenty of, we're nervous a little bit in consumer discretionary, right? We have to be very careful, very discretionary in consumer discretionary, but we have these things, right? But our sort of strongest conviction, I would say, is still more growth oriented. We think there's more room to go there.
And now a word from our sponsor. If you lead or advise at a financial services firm, this may be something to keep on your radar or to share with a colleague. Harvard Business School offers leading professional service firms a 5-day in-person program for working executives to explore topics like corporate culture, talent retention, and how to deliver consistent client value. Held on the HBS campus in Boston, this program focuses on leadership and strategy by working through real challenges at professional service organizations. You'll build a global network across industries and engage directly with HBS faculty. To learn more, visit hbs.me/client. That's hbs.me/client. And Mark, you touched on tech a couple of times just in this in our dialogue here. How do you think about AI? How do you think that may change the management of institutional portfolios? What are the implications there, you think?
Yeah, well, that's a good question. I think that AI as a tool is a phenomenal tool, for all of us, but with lots of caveats. None of them new for us in this industry, right? We always know we were taught, all of us, to read the fine print. And for those of us that didn't, we have all learned the hard way that there's fine print, and you got to start with the fine print. So AI models, we know AI is not always right, but it's a phenomenal tool to gather information, help you cut through the clutter. And so a lot of us are able to consume a lot more information. But I would say it's a great tool for directional correctness. It is not a tool to make decisions on the ground level, right? You still need the models. You still need the portfolio managers. You still need the people. You still need the people who have been doing this for a while and recognize what doesn't look right, and how to decipher the differences, right? So AI as a tool is phenomenal. I think it's generally a very good thing for our business at the institutional investing level to make decisions. There are some real challenges, though, that we might have that can cause problems, right? Because if too much of us rely too heavily on AI, we will all directionally come to very similar conclusions. And so you run the risk of having a bias without even realizing it, for all of us to be biased, because they're all sort of operating with very similar sets of assumptions. It's become much more difficult to be a devil's advocate, which of course we always have had such a robust pushback in our business. There were always that many people shorting it. Not exactly, but there were that many people going on the TV saying, "Hey, no, I'm not trusting this." You have less and less of that, right? People are more consensus now. There's a narrative that it's very easy to fall into, but it's also very easy to miss some very important signals that that we should not miss, in terms of, okay, yes, we're long, yes, we like it, but are we thinking about some of these negative headwinds or what we might see on the horizon that might make us, make some decisions that are slightly different? So I think that this is going to evolve. My fear, though, and I'm going to tell you this for a fact, is that some of the younger folks that are entering the industry right now, I'd say this current level of interns and I'm not referring to anyone in specific, but I can tell you these are all really smart kids right out of school, hardworking kids. All of them have, they make it through the tough layers that they all need to make it through. So they're obviously smart. They're obviously capable of building models and doing the quantitative analysis that's necessary to do what we do. However, they rely now so heavily on AI that I feel like that they're some of them losing some of the understanding of how to understand how the business actually works. Because even some of the rote stuff that even we, right? So earlier on in our careers, we all built models. Then we earned the right to ask other people to build them for us, and we just comment on them. But that was not before we all built those models. And by the way, when we build these models by ourselves, without AI, in Excel, as you can attest, right? Because we have similar backgrounds, you and I. When you build that model, you know where the real strength or the potential problems are with the business, because you know what the sensitivities of the model are, because you built it. So you know what to look for. And even your intuition and your gut is right if you've built the model, because you know where the values are coming from and what the draws are coming from in the model. And a lot of these kids are not doing that today. And I think about maybe a year ago or a year and a half ago, people were still doing it. But now the reliance now is so heavily on that. I feel like that, we have to sort of take a step back. And again, I'm not saying turn off the AI models. I'm a big fan of them. But we have to make sure that this next generation understands that there is a reason that you move up in the rankings, and that you all have to start by building those models, by doing the weekend, the comps that people have to do on the weekend. They take turns in the analyst pits, right? There's a reason we do that. And there was a reason that you and I, when we got started, I was writing in my notebook every day, in my spiral notebook, all the bond yield closes every single night. By doing that every day and every single night, you start to get a feel for what's going on in the market. It took you a while to realize that, and you're cursing out your boss because you had to be there early and you had to do it on the weekends, but you learn from that stuff. And if we rely heavily on all these tools and these crutches, we might lose that nuance, that important thing that I say that still at the top of that, still at the top of the decision making, there has to be people that have the experience and the understanding of what's going on underneath.
And just sort of back on themes here, any particular market narratives that you think are not getting the attention that they should?
Yeah, I mean, I hate to be such a Debbie Downer, but look, there is, just watching SpaceX, this week, I think it's phenomenal. It's amazing to watch, but I feel that there's so much hype right now in the market, and I feel like I've never seen us at such a divergence from the fundamentals. This far exceeds, and I lived through the dot-com bubble. So I feel like I know when something is bubblicious and when something is not. Can't be right 100% of the time. But I will tell you that right now we are so far removed from, in some cases, not all cases, the fundamentals. It's very worrying to me. Look, I go away from the fundamentals. I buy stocks that are at high multiples because I believe the multiples can expand further, or I have to have a really, really good thesis on why the fundamentals are just not correct right now, or how they're going to materially change. It has to be a very solid one for me to go away from the fundamentals, to go beyond beyond the three standard deviations away, which is some of these stocks, specifically, like I said, SpaceX is just rallying hard the last couple of days. phenomenal company, not questioning whether it's going to be huge. But you wonder, what part of that probably 2.5 trillion and growing valuation is just exuberance right now. And you worry how much of that is going to be retail folks that are going to be left holding the bag. And so I think that is a huge narrative that worries me right now, that people just are not even, they don't feel the need to even look at the fundamentals. And we have experienced this, you and I, right? And we've seen this with AOL and, back in the day, and Snapple and all these things that happened during that period of time where everyone was an expert. It was all retail people were experts. Every stock that split, they were buying the split because they knew it was going to go back. And that was the thesis. And it was acceptable. It wasn't acceptable to us. We watched from the sidelines trying to make sense of it. But it made those people look very smart until it didn't. And the result was a huge repricing, and unfortunately a huge destruction of wealth. And so I'm not saying that's going to happen, but I'm saying you're seeing a lot of that now. And these types of valuations, the money has to come from somewhere. Somebody is selling a good pharmaceutical stock to buy SpaceX because they think it's going to be huge. And so, you wonder how that's going to all reconcile. It's going to reconcile. It'll have to reconcile before they land on Mars, or before they discover time travel. The stuff at the back end of the S1,
Yeah, right.
So
What about though, given all these factors, portfolio construction, when you evaluate investment opportunities, what factors carry the greatest weight in your process?
Yeah, well, there are two. I'm going to go back to the old standards: expected return and risk. Those sound so boring because we teach it to freshman finance students. Teach them about that sort of inexorable connection. But that still exists. And when we're constructing portfolios, we are, by buying a stock, we are buying it based on its expected returns, right? So we have to buy stocks where we think these returns are going to meet our expectations. But what are the costs of that? And so for us, we start with the risks first. We look at what are the risks, and then we say within our risk tolerance, what can we buy? Versus saying, this looks really cool. It's going to be really going to be huge. Now what's the risk? Can we afford it? So, for us, when we're constructing portfolios, we're very, very stringent in terms of keeping our risk targets, because that is the pledge that we give to, that's the only pledge we're willing to give to our clients. We will never give them a pledge, we think we can earn this for you. The pledge we give them is that we will not be shocked with the risk that we give you. So are you closer to retirement? What are you using this money for? These are these are the basics, right? That we all learned, but we have to stick to these. And so when we construct a portfolio, we try to make sure that we manage the overall risk. We understand the overall risk. We know where we are taking the risks, and we know where we're breaking away from our discipline. And of course, in those stocks, when we select them, it's about the weighting, right? And so those stocks, they get a lower conviction, right? I want to have exposure to stocks that are trading at high multiple stocks like Palantir. We think there's great potential there. However, you're not going to put an equal weight on that stock as you might put on let's say a Goldman Sachs or JP Morgan Chase or something like that. And so that all is tied to the risk and the expected return. So that is finance 101, but that is a principle that is undying. It still exists. No one has proven it wrong yet. It is still the smartest way to manage a portfolio. Of course, over diversification has its costs also, but that's also where you have to manage how who you're building a portfolio for, who are your clients and things like that. That's extremely important. Some people can tolerate that risk, and they want those huge returns. Not everybody can. So it's really, really important for us to start with risk first, right? Risk can take many, many forms.
In any sectors you'd sort of be more cautious about right now, or just sort of longer term think about underweighting in a portfolio?
Oh boy, that's like a moving target right now for us. I mean, there are, again, if it were so easy, everybody would do it. So goes the old saying. Um, there are sectors that are cheap, but they're staying cheap, and they're not moving. And you can't continue to chase around sectors. Look, healthcare is a troubled sector for me. I feel like there are a lot of cheap stocks there. There's a lot of potential there in certain subsectors, some industries, pharmaceuticals, biopharma, but those are highly risky, right? So you're risking stuff with the biopharma stuff. And the services part of the sector, that's a big challenge. There are a lot of policy issues that need to be addressed there. So we're careful there, but there are things that look very, very cheap that might be value traps. We worry about value traps. Um, uh, Probably a month or two ago, I would tell you that software within the tech sector is cheap, and you see people try to rotate into that in a couple of missed attempts. Those stocks continue to get beaten up despite best intentions, and the companies are doing very, very well on paper. But the market is the ultimate arbiter, and the market just will not let some of these great stocks like Salesforce, like Intuit. These are the usual suspects. Adobe. These are companies that are fabulous companies, have great prospects, have great fundamentals, but the market's not buying it. We have to watch those. So we might worry that those are starting to look like maybe value traps, and we have to reassess, our thesis on those stocks. Is the market seeing something that we're not? Are we mispricing it? So we see that. I think consumer discretionary. Um, that is a driver of economic growth, and a lot of those companies are trading really, really rich. And as I just told you, I'm not a Debbie Downer, but there are just so many of the economic indicators, some of the softer numbers, like the sentiment indicators, they're all pointing toward pressure and pain for the consumer. And if that's the case, how could we expect margin expansion, on the top, on already expensive consumer discretionary stocks, which incidentally are also trading at record high gross margins, which is also shocking considering what we think is flowing through the system now. And so, we're watching margins carefully. Now, I'll tell you that because that may not continue, because we did see a big margin expansion in Q1. And whether that can continue, whether that's just companies trying to dress their numbers, hiring less people because they are trying to use AI or whatever, that stuff can't last forever. You can't expand margins forever, So we watch out. Consumer discretionary is one I watch out for. Software within technology, I'd watch out for. I would be very careful in healthcare services. That can't go on forever. Policy is going to have an effect on that. We have these midterms coming up. We have not seen the policy come out of Congress that we would have hoped to clarify, but we'll see. Hopefully, it won't get worse. Hopefully, it'll get better. Indications are it'll probably get worse, more stalemating. So those are the ones I'd watch out for.
And technology, obviously, a significant portion of the market returns.
Yeah,
How,
we
how
still
should
like it.
but how should investors think about concentration risk in the
Yeah,
indices?
that is a big one. Concentration risk. It's very hard to ignore that. Concentration risk is happening for so many reasons, right? The stocks that have the best potential growth right now are there. The companies where the most amount of spending and flows are going to are there. They also dominate the index, which is if we look at the S&P 500, the breadth is terrible compared to the equal weighted index. That can stay and it can persist for some time, but for how long? right? And that always works until it doesn't work. So I think there is an enormous amount of concentration risk right now. You know, the S&P 500 is thankfully going to maintain its stance on how it constructs the index. The triple Qs is going to allow SpaceX to join, and that's going to cause a lot of concentration on the top of certainly the Nasdaq 100. Not so much so on the S&P 500. That'll change because those funds have to flow from somewhere too. So there's a lot of concentration risk out there. How do you approach it? You approach it very, very carefully. And the big challenge is there's so much money right now in those index ETFs that have probably more exposure than many retail investors know about, and even in their retirement accounts, they probably are more concentrated risk in 5 to 10 companies than they even know. And then they're buying these companies individually in their self-directed accounts. And so there's a lot of that risk out there now. I would just say, to the extent that you can control it, I think buying the index is still a smart thing to do. When all else fails, buying the index and holding long-term focus, it wins. We have the numbers to prove it. You do that and you win all the time for no other reason. However, once you start buying individual stocks on your own, or if your advisor is telling you to buy these things, you should be very careful not to have too much. You can control that. Do you need more NVIDIA if you already have so much NVIDIA in your SPY? Do you need more SpaceX if you already have it in your QQQ, and so on? So, the message there is look carefully, and beyond the indexes, which again, they're very biased. You have to be very smart about what you buy and self-directed.
And what about the traditional 60-40 portfolio? Has that sort of gotten lost in the shuffle here? Where does that fit in today's environment?
Yeah, for a minute, very much so. I think when you had record high interest rates, low interest rates before 2022, I think all of us were, sort of looking at each other saying, "Oh my God, we're diversifying into bonds, trading at all-time highs after a 25 to 30-year secular bull market, yields so low they don't make sense. They have nowhere to go but up from here, and stocks trading at all-time highs. So, the correlation between stocks and bonds and everything really, really made life difficult for people who were looking to diversify away systematic risk, right? And so for a minute, it wasn't working, right? That 60-40 portfolio was really your worst enemy, because people putting their money there were doing it to protect themselves from downside. And they lost more because everything went down. And we also know, by the way, and we know this in practice, that anytime the market has a big move, all asset classes kind of get correlated for a minute. But ultimately they return back. And you do gain from this statistical, benefits of diversification. But now you have yields trading so high at such high rates, which I'm not saying they can't go higher. They absolutely certainly can. If nothing changes right now, Gary, there's probably more upside in yields than downside, right? If you just left it at its current, momentum. But I would say longer term, I would say the 60-40 portfolio is a little easier for me to swallow right now, because I know that rates will eventually have to come down, and at some point. There are a lot of challenges to that. However, I'm more comfortable because at least here, by the way, we're getting a respectable, attractive returns. Obviously on that side, by the way, I would caution duration risk. You got to think about that, right? So you also want to make sure that you're in the right place of the curve, that you're not, buying stuff that has not factored in the term premiums properly. But that said, 60-40 is probably better today than it was 3 years ago. So it's not dead, um, but it's something that you need to look very, very closely at, and not just jump in. And like it was a no-brainer, and then you moved your way from there. That was the start, and either more risky or less risky than 60/40. But starting point should, it's okay to be 60/40 right now and think about it.
Lastly, we've covered, a wide range of topics, market topics here from process to construction to some of the market uncertainty areas. In summary, for the balance of this year and maybe a few months out, what is the investment playbook look like? How do you see it?
Okay, the investment playbook, I would say, I would call it like, well, for those of us who live in I live in the Northeast, so we have ice in the winter on our lakes. I would say that you learn at a very young age to be very careful about walking on the ice in March, right? Because anything goes in late March. I'd say you have to be very, very careful at this point. I mean, I think valuations are all being tested at this point. I would not say that, using old standards of 22 times forward is expensive. I'm not saying that that's the way to go, but I feel like there are plenty of good stocks that are expensive that deserve to be expensive, and that you can expect multiples to continue to expand. I would say right now we have to have going forward a very, very sharp pencil. Okay. We cannot rest on what worked last year for us. When I say tech, I don't mean just invest in everything tech. Don't invest in every memory company. Understand why you pick one versus the other. And I think no, people are not in that mindset yet. But I think that to be prudent going forward, we have to just be very, very careful. I think we have upside room still in the indexes. I think there's still plenty of room in the AI trade. I still think we're early days. I think we still have plenty of room there. I think now we have to be careful. I think we have to really pay close attention to the Fed, because the Fed was a very, very known entity for us since 2008. Since Bernanke, for sure, I feel like the Fed was, how they always have these things on Fed Day where, they ask a bunch of people, where do you think the Fed's going to do? It became pretty easy to win that prize, right? Because there was so much signaling that was going on over there. But I think that's going to change, certainly under Warsh. And so we're going to have to get back to a lot of basics. And that's what I'm going to be doing this year. I'm going to be wearing comfy shoes for the rest of the year, and I'm going to have lots of pencils on my desk, not pens, but pencils, because I guarantee there's going to be a lot of erasing happening over the next let's call it 6 to 9 months through the next to the year end.
Mark, thank you for sharing your highly valuable insights and perspectives with us today. And to our listeners, thank you for tuning into Compound Insights from CFA Society New York. We'll be back soon with more conversations with leaders in finance. Until then, I'm Gary Farber. Thank you for listening, and we'll see you again soon. Leading a financial service firm requires a distinct approach to strategy and leadership. That's why Harvard Business School Executive Education offers a 5-day in-person program focused on leading professional service firms. In this program, participants like you will explore topics such as corporate culture, retaining talent, and communicating a strategy and vision. By the end of the program, participants will gain frameworks to lead change while preserving client satisfaction. Explore the program at hbs.me/client. That's hbs.me/client.